charitable giving, certainly, still alive and well, and as an itemized deduction, um, should, be used in coordination with your standard deduction. Um, and remember that if you're married filing joint and you do not have a mortgage, you're limited to $10,000 of state and local income taxes, and provided you have no casualty, theft, or losses, that may be your only itemized deduction, $10,000. If you are someone who gives to charity, and let's say you give $10,000 a year, married filing joint, that $10,000 has no beneficial impact because you're getting a $24,400 standard deduction to start with. So there's this concept of bunching charitable contributions. So if you're somebody who gave or gives $10,000 a year to charity, what you may want to do is, instead of giving $10,000 annually, give $20,000 in 1 year and forego the following year. This way, with your state and local tax deduction of $10,000 with the limit, $20,000 of a charitable donation, you would be able to deduct more than what's given to you with the standard deduction. So there are, the ability, to plan and bunch charitable deductions to try to take advantage of saving taxes rather than having a charitable deduction totally go to waste. And you can see just, making annual contributions, how much that might save you with regard to state and local taxes, mortgage interest, and charitable deductions versus bunching deductions. And you see in year one, putting your $30,000 of charity into 1 year, to produce $7,000 in total savings, and then just taking the standard deduction in years 2 or 3. So that's something everyone should consider, particularly if they do donate to charity. Another concept that has gained in popularity is something called a donor advised fund. Donor advised funds, they are available with most mutual fund companies. They allow you to make a significant gift into the fund and not have to distribute the contribution to charities at that time. You'll get a full tax deduction for whatever you contribute to a donor advised fund, and then you direct, when and to whom you want to make charitable contributions from that donor advised fund. So in the example on the left, you could put the $30,000 into a donor advised fund, even though you may not be sure which charities you want to donate to. You will get a full deduction for the $30,000, and then have the ability to donate over time to certain charities as long as they're qualified 501c3 organizations. And so you can get the lump sum deduction today and then have disbursements made to charities over various years in the future. When you give cash assets, the law was changed this year to allow 60% of your adjusted gross income up to a limit as far as cash deductions, and then with non-cash deductions limited to 30%. So there are certain limits to your adjusted gross income, but the donor advised fund certainly can help those who want to give more to charity and take advantage of the tax code. But bunching charitable contributions, I think, is a very wise strategy to save taxes rather than waste a tax deduction. With the CARES Act passed in March, they created a above-the-line charitable tax deduction. It's up to $300 for an individual taxpayer and $600 for married filing joint. So this is an item that you're going to be able to take right off your income. It's not significant. I know in both the HEROES Act and with the Republican Act that they had put forth, they were looking to increase the dollar amount to make this more of a significant deduction than either 300 for individual or 600 for married filing joint. But that's available right now. So when you file your 2020 tax return, you will have the ability to make a charitable contribution and receive a deduction above the line and not be limited by itemized deductions. Okay, so there is some planning to do with charitable giving. Another area that has to do with those who are age 70 and a half or older. There's something called a qualified charitable distribution. Now, we're going to talk about the Secure Act, which was passed in December of 2019. That changed the age in which you were required to take distributions from your retirement accounts from 70 and a half to 72, okay? But qualified charitable distributions are still available to those who have attained age 70 and a half. And so if you're 70 and a half and you are someone who gives to charities, you have the ability to take an amount up to $100,000 per year out of your IRA and contribute it directly to charity. You're not taxed on the income, nor do you get a tax deduction. But by making a qualified charitable distribution directly to the charity, you're not limited by any income, just to go with gross income limitations, as I mentioned before, 60% for cash or 30% for non-cash. So those who have an IRA and we're giving to charities should take a look at a qualified charitable distribution. Realize the amount that you give through a qualified charitable distribution is reduced by any IRA contribution you make, tax-deductible IRA contribution you make if you're still working and making contributions to an IRA. Another item to note, that if you take advantage of a qualified charitable distribution, there is no special tax reporting when you get your 1099-R. It would make sense to put a box where it's a charitable, qualified charitable distribution, but you need to let your tax preparer know that if you take advantage of this provision of taking money out of your IRA and having it donated to charity, that it's not included in your income, nor do you get a tax deduction. But the most important thing is that you're not taxed on it. So this provision still applies and is available.